Financial freedom. It's a dream for many, a reality for some. But how do you get there? It's not about winning the lottery or inheriting a fortune. True financial freedom comes from making smart choices with your money, especially when it comes to investing. Investing is simply putting your money to work for you. It's about making your money grow even while you sleep. Smart investing is about understanding different investment options and choosing those that align with your financial goals. Whether you're just starting out or looking to grow your wealth, remember this: investing is a journey, not a sprint. It's about making informed decisions, staying disciplined, and watching your money grow over time. So, are you ready to take control of your financial future? Let's dive in and explore the world of smart investing together. Let's start with one of the most well-known investment options: stocks. Simply put, a stock represents a piece of ownership in a company. When you buy a stock, you're buying a small share of that company. Companies issue stocks to raise money for growth and expansion. When you buy stock, you become a shareholder, participating in the company's potential success. If the company performs well, its stock price typically goes up, and your investment grows in value. Of course, there's always risk involved. If the company doesn't do well, the stock price may fall, and you could lose money. That's why it's crucial to research companies carefully before investing, and to diversify your investments. Remember, investing in stocks is a long-term game. Don't panic over short-term market fluctuations. Stay focused on your goals, and you'll be well on your way to building wealth through the stock market. While stocks offer the potential for higher returns, they also carry more risk. If you're looking for a more conservative investment option, bonds might be a good fit. A bond is essentially a loan you make to a government or corporation. When you buy a bond, you're lending money for a fixed period, and in return, you receive regular interest payments. At the end of the bond's term, you get your principal back. Another popular investment option is mutual funds. A mutual fund pools money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. Mutual funds offer instant diversification and are managed by professional fund managers. Whether you choose bonds or mutual funds, remember to do your research. Consider your risk tolerance, investment goals, and time horizon before making any investment decisions. Real estate has long been a popular investment choice, and for good reason. Unlike stocks or bonds, real estate is a tangible asset. You can see it, touch it, and even live in it. Investing in real estate can take many forms, from buying rental properties to flipping houses to investing in real estate investment trusts, REITs. Each strategy comes with its own set of risks and rewards. Rental properties can provide a steady stream of passive income. Flipping houses, on the other hand, can offer the potential for quick profits, but it also requires more work and carries more risk. REITs offer a way to invest in real estate without the hassle of property management. Before diving into real estate, educate yourself on the local market, property values, and rental rates. Remember, location is key in real estate, and thorough research is essential for success. Section 5. The power of diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This adage holds true in the world of investing, where diversification is key to mitigating risk. Diversification simply means spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities. By diversifying, you reduce the impact of any single investment on your overall portfolio. Think of it like this. If you invest all your money in one stock and that company goes bankrupt, you lose everything. But if you diversify across different stocks, bonds, and other assets, the impact of one bad investment is minimized. Remember, diversification is your best defense against market volatility. By spreading your risk, you increase your chances of achieving long-term financial success. Section 6. Baby steps to big dreams, investing with small amounts. You don't need a fortune to start investing. In fact, you can begin with small amounts of money and gradually grow your portfolio over time. One of the easiest ways to start investing with little money is through micro-investing apps. These apps allow you to invest your spare change, rounding up your purchases to the nearest dollar and investing the difference. Another option is to start with low-cost index funds or exchange-traded funds, or ETFs. These funds track a specific market index, such as the S&P 500, providing instant diversification at a low cost. The key is to start small, be consistent, and take advantage of the power of compounding. Even small contributions made regularly over time can grow into significant wealth. Section 7. Learning from the best examples of smart investment strategies. Throughout history, successful investors have used various strategies to build wealth. One famous example is Warren Buffett, known for his value investing approach. Value investing involves finding undervalued companies with strong fundamentals and holding them for the long term. Buffett looks for companies with a durable competitive advantage, a history of profitability, and strong management teams. Another successful strategy is growth investing, which focuses on companies with high growth potential. Growth investors look for companies in expanding industries with innovative products or services. Remember, there's no one-size-fits-all approach to investing. The best strategy for you will depend on your risk tolerance, investment goals, and time horizon. Section 8. Avoiding common pitfalls. Navigating the investment landscape. The world of investing can be complex, and even experienced investors make mistakes. One common pitfall is emotional investing, letting fear or greed dictate investment decisions. When the market takes a downturn, it's easy to panic and sell your investments at a loss. Conversely, when the market is soaring, it's tempting to chase returns and invest in risky assets. Another common mistake is failing to do your research. Before investing in any asset, take the time to understand the underlying fundamentals, the potential risks, and the historical performance. Remember, investing is not a get-rich-quick scheme. It requires patience, discipline, and a long-term perspective. By avoiding common pitfalls and staying focused on your goals, you can navigate the investment landscape with confidence. Section 9. The long game, patience, persistence, and the power of compounding. Investing is a marathon, not a sprint. It's about making smart choices, staying disciplined, and letting your money work for you over time. The key to long-term financial success lies in understanding and harnessing the power of compounding. Compounding is the snowball effect of earning interest on your interest. As your investments generate earnings, those earnings are reinvested, generating even more earnings over time. The earlier you start investing, the more time your money has to compound. Even small contributions made consistently over a long period can grow into a significant nest egg. Remember, patience and persistence are your allies in the investment journey. Stay focused on your goals, ride out the market's ups and downs, and let the power of compounding work its magic.